Welcome back, everyone. As you know, the pandemic era support programs for student loans, those have ended. And we're seeing some interesting credit challenges emerging for borrowers. So today we're going to really zero in on those potential impacts on credit scores. And to do that, we're going to be looking at some really interesting recent research findings. So please like and subscribe if you're finding this information helpful. So, during the pandemic, a lot of people got a bit of a break. Federal student loan forbearance kicked in, and actually initially borrowers' credit scores looked pretty good. There was a recent report that showed an 11-point median credit score increase. This was between late 2019 and late 2020 for people with student loans. But, when you did a little deeper, the situation, it wasn't as simple as just general improvement. If you look at the borrowers who are already kind of struggling, behind on payments, but not fully in default, be impacted by forbearance, it was really good. If you think about those with student loans who went delinquent in 2019, their median Equifax risk score went from 501 in Q4 2019 up to 575 in Q4 2020. So that's a 74-point increase. And wow, that's a huge jump. And it really shows, how much your payment history or the lack of it during forbearance really affect those credit scores, especially if you already had your dings on your record. Now, this also suggests that any scores got temporarily inflated, and it might go back down now that things are back to, normal. And what's interesting is after that, the initial bump, the scores for those who had been delinquent, they kept getting better as those negative records got older. But the people who were consistently paying on time, their scores pretty much stayed the same during this whole time. Now, borrowers who were already in default, they had a different experience. Their scores went up slowly because those negative records are getting older, and some people went into those voluntary rehabilitation programs. A big change happened with the Fresh Start program that started in late 2022, and that program basically said, hey, all those defaulted loans, they're current now. So that meant a median scoring increase from 564 in Q1 2022 all the way to 608 in Q1 2023. That's a 44-point jump for that group. And by the end of 2024, both the delinquent and defaulted borrowers, their scores were way higher than back in late 2019. We're talking 103 points higher for the delinquent folk and 72 points higher for those who had defaulted. But keep in mind, those median scores, they were still under the subprime level, which is 620. So that's important to remember. But when you zoom out and look at all student loan borrowers, the percentage with those subprime scores that did go down from 36.2% in 2019 to 28.2% in 2024. So overall, that seems like a good thing, at least on the surface. Now, let's talk about something that's a little harder to see. It's a hidden problem, but delinquency rate. Those negative marks on your credit report, they usually show up after you miss payments for 90 days. So with that payment pause ending the first quarter of 2025, household debt and credit cordially report might show a big jump in student loan delinquency, but we can't really know for sure right away. To try and get a better handle on how many student loans were actually delinquent at the end of that payment break, we looked up the newest data we have from September 30, 2024 from the FSA, so that's Federal Student Aid, and the New York Fed Consumer Credit Count, or CCT. So we came up with this idea of a hidden delinquency rate. And here's how we figure that out. We take all those loans that are 30 or more days delinquent from the CCP and the SSA, and we added in those federally managed defaulted loans as delinquent too, since those payments we started, And then we take that total delinquent debt and divide it by the total student loan balance from the CCP. So that gives us an idea of how many borrowers were actually struggling even before those 90 days were up and things started getting reported officially. If you go back and look before the pandemic, this hidden delinquency rate was highest at 14.8% in Q2 2018, and it stayed around 14% for all of 2019. When the pandemic hit, the rate went down because of the loan status changes in that Fresh Start program, but as soon as payments started up, the amount of delinquent federal loans, it went right back up to where it was before the pandemic. By the end of the payment on-ramp, it hit a new high of 15.6%. So now we're talking over $250 billion in delinquent debt, and 9.7 million borrowers are dealing with this. That's a lot of people. Of course, things might have changed since that on-ramp ended. Maybe some borrowers caught up and some fell behind. We don't know for sure yet. But there's these legal battles happening that are messing with repayment too, like IDR applications are on hold and people in this AV plan are in forbearance because of a lawsuit about the plan. So some borrowers can't get into those IDR plans that might help them, and others in this AVE plan, they're safe from delinquency for now, but it's hard to say what the overall effect of all this is going to be. We'll have a better idea when the FSA updates their data by the end of 2024 and when that Q1 2025 household debt and credit quarterly report comes out. So the past data does show some improvements from forbearance, but it's super important to figure out what's going on now that payments are back. That's why this hidden delinquency rate and how much it's gone up is so important. So let's shift gears and think about what all these new delinquencies could do with credit scores. It's very possible, based on what we know, that student loan delinquency delinquencies could be even higher than they were before the pandemic as those new delinquencies are reported. Now, some borrowers might catch up or work something out with their loan servicer, but the hit to their credit score it's already happened, and those negative marks that can stick around on your credit report for up to 7 years. So we looked at data from 2016 to 2019. We tried to estimate how much a new 90-plus day delinquency on a student loan would affect someone's credit score based on what their score was before. And the estimates are pretty eye-opening. If you had a super prime credit score, 760 or higher, a new 90-plus day delinquency could drop your score by an average of 171 points. That's huge. Imagine you had great credit and were thinking about buying a house or a car. That kind of drop could really derail your plans and make borrowing a lot more expensive. Now, if you had a subprime score under 620, the average drop is estimated to be around 87 points, still a big hit. Based on all this, we think over 9 million student loan borrowers might see their credit scores take a serious dive in the first quarter of 2025. Now, how much this affects people's ability to get credit is going to depend on what their credit score was like before. If most of the new delinquencies are from borrowers who already had low scores, the overall impact might not be as bad since they were already having trouble accessing credit. But if those prime and super prime borrowers, the ones with good credit, they start listing payments, then the total credit worthiness of all student loan borrowers, that could plummet, and that could mean lower credit limits, higher interest rates on new loans, and just overall less access to credit. So we're going to keep watching these student loan delinquency trends really closely as we get more data in the next few months. To wrap things up, the end of those pandemic support programs, it's put student loan borrowers in a really tough spot when it comes to credit. Right now, our best guess is that millions of borrowers could see their credit scores drop significantly in early 2025, and those delinquencies are going to stay on their credit reports for a long time. That's a real challenge. So we all need to keep a close eye on what's happening with student loans and support borrowers who are trying to figure all this out. It's a really tough time. Thank you for joining us today, and please like and subscribe for more of these deep dives. We'll see you next time.